into income until you sell the security. Okay? Then you debit your cash and credit your asset, and the difference is the gain. All right. So you can see here, this is the end of the year, premiums written and premiums actually earned. So that means there's a little mismatch timing-wise. Timing-wise. All right. And you can see the interest. Why is interest such a big piece here? Interest, and then dividends, and then, so why is interest a big piece?
It's mostly bonds.
Bonds, because the company owns bonds. And dividends don't come from bonds. Where do dividends come from? Dividend-paying stocks. And, you know, I would say probably maybe 50% of companies or less pay dividends. Okay? A lot of growing companies don't pay much dividends. So if you're earning dividends like this, we'd have to check to see what your market value is to see what the yield is. But you're buying large company stocks that pay dividends. Okay? And then what's rental income? Where's that from? That's from the commercial real estate that insurance companies own. Okay? And then gain on sale, like I said, that comes from trading securities. Okay? So you look at it and you go, wow, the revenue from premiums, okay, and the income from securities. And what do you see? What do you see?
$180 million difference.
Yeah, I mean, this is really small compared to this. But in a minute, we're going to see why this is so very, very important. Why do you think it is?
Eventually, premiums are used to fund the losses.
Right. We've got claim expenses that have to be deducted from this. Very little is deducted from this. So at the end of the day, the actual net income that you earn a lot of net income out of that, $18 million, and you basically break even on this. All right. Come on now. There we go. Okay. So let's see what we got. So these are all the costs. So you have claims losses, and you have commissions that you have to pay, and then taxes you have to pay. This is the staff that you have to pay, and here's your total underwriting expenses. You don't have any of those. All right, so your net income before taxes, you've lost money on underwriting. What did we say it was, 203 million?
223.
223? Something looks off. So that would be 10 million plus your
205 was the 205 million was the premium.
the premium. That's what. Yeah, that's what I meant. Okay, 205. So you had a $7 million loss on the insurance side of it, and an $18 million gain from your investments. Which, when you net that out, you got an $11 million income. That's an interesting business model, if you ask me. Okay. Oops, I left something off there. Okay. So now we're going to have to do some calculations. Okay. So I'll let you bring in a card for the next for the next exam. So the loss ratio is the ratio of incurred losses and adjustment expenses to the premiums earned. Looks a lot like the combined ratio. Okay, so the loss ratio are your incurred losses plus your loss adjustment expenses divided by your premiums earned. All right, and basically that's what we just looked at. Okay. Then the expense ratio is just your underwriting expenses. This does not include your losses divided by the premiums. The premiums that are written, not earned. Okay? So now we're starting to get into ways to assess and compare insurance companies. How are they doing? Okay? How are they managing their expenses? And how are they managing their underwriting? Are they doing a good job picking risk? That's part of underwriting. Are they doing a good job pricing the risk? That's a part of underwriting. Okay? I can tell you one thing that's interesting to me, let's go back for a minute, is this is for property casualty. So 18 million in commission on 205 million, that's a 9% commission. Okay? And that's a little lower than I would have expected. And I can tell you in the life insurance business and in the health insurance business, it's higher. The commission rates are higher. In the health insurance business, the commission rates run about 12%. Okay? And in the annuity business, it runs about 25%. The commissions are ginormous. I remember years ago I was talking with a guy who has a health insurance company. He's an agent. He has an agency. And we were talking about what he does and what we do. And he's not very intellectual. This guy, he goes, you know, I was a C student. Oh, he's a multi-millionaire, multi-millionaire. And he says, when you get a portfolio, how much do you charge? I said, 1%. He said, is that typical in your industry? I said, oh, yeah. He goes, man, when I sell an insurance policy, I get 12%. Now, I didn't make A's and B's on my exams, but I'd rather get 12% than 1%. Like, dude, you got me on that one. You're right about that. All right, so let's go back here. Okay. And then the combined ratio, which we've already looked at, is the sum of the loss ratio and the expense ratio. Okay, so this tells us how we're doing on our underwriting. And underwriting consists of underwriting expenses and losses. Okay? And underwriting expenses are not the same as losses. Underwriting expenses are the SG&A. This is the cost of running the underwriting department. This is the cost of risk. These are the claims. Okay? So you got to pay people to run the operation, and then you have to pay claims to your customers. Okay? And together, that makes up your combined ratio. So, are you making money on the insurance side or not? Sometimes you do, and sometimes you don't. But more often than not, you're running around break even, and you're hoping that the investment side will cover you. Oops. So if your combined ratio is greater than 1, because your expenses are in the numerator, you're losing money. Okay? investment income ratio compares the investment income to your earned premiums. It's another way of assessing an insurance company, of judging how has that percentage looked over time for your company, and how does your company's ratio compare with your competitors. It's how we judge management. Okay? These are performance measurements. Okay? So there's your net investment income to earn premiums. So you're going to have these ratios handy on a card to do some calculations. And you'll have some to do in homework. The overall operating ratio is the combined ratio minus the investment income ratio. So now what we're doing is comparing our income, which includes our underwriting income and our investment income, to our written premiums, our earned premiums, I'm sorry, our earned premiums. Whoops. There we go. So the combined ratio minus the investment income ratio gives us our operating ratio. Okay? Once you do it a couple times, it'll make sense to you. All right. All right, let's shift back into the balance sheet, and we're looking at life insurance. So that was property casualty. Now we're looking at life insurance, which is a different kind of business. Okay? And again, most insurance companies are formed to do one line of insurance. That's the history behind those companies. But over time, those companies add other lines of insurance. Okay? But they still have a history and a culture and are known for either life insurance, health insurance, or property casualty insurance. State Farm has life insurance, but that's not what they're known for. They're known for property casualty. Okay? New York Life has property and casualty insurance, but that's not what they're known for. All right. So a property casualty policy is pretty short term. You know, I bet the average is probably 5 or 6 years between the fact that people move, and when you move, your policy is canceled automatically. Okay? But with life insurance, these policies are almost never canceled. So they tend to be very, very long term. Okay? 20, 30 years. All right. And we talked about the two investment accounts. Okay? The general account, which funds death benefits. Okay? And also the savings. And we'll talk about the fact that a whole life policy consists of two parts. I don't want to get too far ahead. But a whole life policy consists of your life insurance and some savings. Okay? All that goes in the general account. That's what I want to say here. All right. So the savings goes into what's called a cash value account. And that's what people access. You can borrow money from that cash value account. So every time you pay a premium, part of it goes to cover insurance, and part of it goes into a cash value account. And you, at any point in time, you will get a printout, you get a printout from your insurance company that tells you what your cash value account is worth. And that's money you can borrow. Okay? And I do want to caution you about this because insurance agents make a really big deal out of this. And you've heard me say it in other classes. Okay? They say one of the big benefits of insurance, whole life insurance, is you can borrow money against it or from it tax-free. And they act like that's some kind of a magic thing. Okay? But if you go to the bank and you apply for a $10,000 loan, and the bank says, yes, we will give you a $10,000 loan. Do you put that $10,000 on your tax return as income? And the answer is no. Not at all. So, being able to borrow tax-free is not anything magical. The insurance companies are not doing anything great for you. And by the way, you're borrowing your own money. It's your money. You put it in. And now you're borrowing your own money. And they're charging you an interest rate for it. Your own money. Okay, we'll get into more detail about that. But I just don't want you to be bamboozled, because people who sell insurance will tell you that, and people who haven't taken classes like this, they really think they're doing something special for you. I mean, they really do think that. And then you have to point out to them that there's nothing magical about that. I mean, I'm glad to have access to it, but I'm borrowing my own money, and you never pay taxes on the money that you borrow. All right. Okay, so the insurance company, because the insurance company would otherwise invest your money and earn a rate of return on the money. If you borrow it, they don't have that money to earn a rate of return on. That's why they charge you an interest rate, and you pay that not to your account, but to the insurance company. Okay, so you have to be really, really careful about that. If you borrow money from your 401k, you have to pay an interest rate on it. That interest goes into your 401k. Okay? But if you borrow from your insurance, life insurance, the interest you pay does not go into your account. It goes to the insurance company. All right? So be clear on that. All right. Now we're talking about the separate account. So life insurance companies sell products that offer returns that are tied to movements. They're not tied directly into the products themselves, the securities, but they're tied into what the securities do. There's a difference. There's a difference between someone who says, if interest rates go up to 3%, then we'll pay you 3%, and you actually owning the securities that are paying 3%. Because you don't actually own those securities in this account. The insurance company does. Okay? So they may say, you'll get 80% of the return of the stock market. You don't own the stock market. They do. And they'll pay you. And if the stock market was up 10%, then your payout is going to be 8%. That's how much your account would be credited. Okay? That's how it works. Okay? And these products include universal life, which we'll look at in the life insurance section, which is the first product we'll look at is life insurance, and variable annuities. And both of these products give you the opportunity to earn returns that are tied to bonds and stocks. And these are held in the separate accounts. All right. And again, your money, they pool money, it's not actually in there, but you have a pro rata interest in it. And so, as we saw in the breakdown between the general account, how the general account at life insurance companies is invested, it's 80% in bonds, and the general account, the separate account at life insurance companies is 80% in stocks, because that's what people want to do with these products. They buy those products in order to earn returns like this, okay? Owning universal life and variable annuities are ways to invest in stocks and not pay any taxes on the interest, dividends, and capital gains, because you own them inside of a life insurance policy. Now, that is a benefit of investing through a life insurance policy. That is a benefit. It's very similar to an IRA or a 401k. The money is invested and it's earning dividends, interest, and capital gains, but while it's invested, you don't pay taxes on any of those things. Now, once you start receiving, now if you get death benefits, they're not taxed, but once you start receiving income out of these accounts, the income is taxed. The income above what you pay in is taxed. And we'll get into that. That's important to know. See, is your head starting to spin a little bit? Just a little bit? Oh yeah. It gets a little confusing. That's why you have to take it one small step at a time. Because the number of products out there is mind-boggling. And each product is customized. You buy an annuity, and the booklet is like this thick. And they're really difficult to understand. Okay? And I have a rule of thumb that I learned from some really smart people. If you don't understand what you're buying, then you don't buy it. You don't buy it. And I've noticed over the years that students that I've had in class that made D's and C's, and then they come back and try to sell me these products, and they're explaining them to me, and I'm not understanding them, and this isn't going to sound good, but here's the way I figure it. If I don't understand them, and they made C's and D's in my classes, I seriously doubt that they understand. Sorry. You know what I'm saying? So if you don't understand what you're buying, your default answer is no. And when someone says you have a short period of time to decide, your default answer is, oh, I don't need any time to decide. The answer is no.